Hi, and welcome back. Last time we talked about inflation and some price changes, and we also took a look at the Federal Reserve and some of the things that they can do in order to try to control the economy from inflation going too high or deflation starting, some of the controls and tools that they have to make the economy run a little bit more smooth than it would otherwise. Today I want to talk to you about some other tools that they have, what they can do when what they were doing isn't working, or when we go into a financial crisis. A crisis like 2008 when the housing bubble burst, or a crisis like today where so many people have been laid off and we're dealing with this coronavirus. We don't know how we're going to come out of it. What can the Federal Reserve do to try to stop the economy from going as bad as it can? One of the first things that they can do is their normal open market operations. We're going to differentiate between those and what's called quantitative easing. Now that's a big, scary sounding word, but don't worry, it's pretty easy to understand, and we're going to break it down so that it's not as scary as it seems. The next one is called forward guidance. After that, we're going to talk about stimulus and how the Federal Reserve is involved in that. We'll take a look at term repos. We're also going to examine foreign central bank swap lines. What are those? How does that help? So, let's start taking a look at this. Let's get started. Let's take a look at these open market operations. The Federal Reserve has several tools at their disposal. This is a really powerful one. This is what they normally use to target the federal funds rate. They do this by trying to manipulate the interest rate to either slow the economy down or to speed it up. And how they do this is they distribute money into the economy. Now, the Federal Reserve doesn't print money. The U.S. Treasury prints money, but the Federal Reserve is in charge of distributing it. And most of the time when they pour money into the economy, it's just digital money. It's numbers on a computer screen, but it's going to affect the economy whether it's real or whether it's just imaginary numbers in a computer system. So this money is going to go into the banks. And what the banks are going to do is they're going to sell the securities to the Federal Reserve. So the Federal Reserve is using their money to buy securities from the bank. So the bank is going to have more money to lend out. The supply of money is going to be higher, and the demand for securities is going to be lower. That's going to make it so banks have more in reserve. They don't have to borrow to meet the reserve requirement every evening. They're going to lend out the money. That's going to stimulate the economy in the idea that it's going to lower the federal funds rate. This is a very effective tool, but in times of financial crisis like today, the federal funds rate can only go down to 0%. Once it hits 0, the Federal Reserve needs to use some of its other tools that it has at its disposal in order to try to stop the economy from tanking any further or getting any worse than it is at the moment. Okay, let's get to this big scary word, quantitative easing. What in the world does that mean? Let's break down the word first. Quantitative. We know the word quantity. It means a number of something, right? We've heard of quality, that's craftsmanship, that's building something that's going to last, that's made really well. Quantity is a number of something. It's a lot of something. And easing, well, that just sounds like we're easing into it. We're going slowly. We're not doing anything drastically. So there's a whole lot of stuff that's going to move slowly. That makes some sense to me now. So what is it? Well, this is the same process as the open market operations. The Fed creates money, they inject the money into the supply, they open the spout and pour it into the economy. It's just what they're buying is a little bit different. They could be buying long-term debt, or they could be buying the same thing, the treasury bonds and securities, but those are just long-term bonds and securities, maybe 10 years to maturity instead of 2 years. When you do the open market operations, it's all short-term money. When you do quantitative easing, it's the same thing. It's just long-term intervention instead of in the short term. They can also buy some different things from the private sector. One example would be mortgage-backed securities. This is the thing that caused the financial crisis of 2008. This and then some other compounding effects is these mortgage-backed securities. And a lot of that also had to do with the repeal of the Glass-Steagall Act. So those of you that are going to be looking at the Great Depression and those of you that are going to be looking at the housing crisis of 2008, the Glass-Steagall Act is important. We'll get into that a little bit later. It's the government putting its hands into the private sector of business, into banking, and being able to mess around with it. But we'll save that for another day. Now that wasn't so bad. Let's look at a few other things that the Federal Reserve can do. These are pretty easy and straightforward to understand. Forward guidance. This is the Federal Reserve just telling us what they're going to do. They agree to announce what their long-term intentions are to the public to ease any sort of market volatility. They say that we're going to have these low interest rates for maybe the next 2 quarters. And that is going to make it so that people don't panic, that they don't speculate. They know what the Federal Reserve is going to do, so they can go about their business based on that understanding. It makes the market a little less volatile when they do that, in theory anyway. Now the stimulus, this is done by Congress and by the president. This is a law that gets passed and it comes out of the budget. The Federal Reserve is in charge of distributing the money. They send the money wherever Congress agreed the money would go to, but they can't do anything other than that. They have to abide by what the bills are. They can't manipulate that money in any way. They can't change it. Whatever Congress said and whatever the president signed, that's where that money is going to go. Now, this next tool that the Fed has is called term repos. They're a lot like the open market operations with just a little twist to it. Now, the Federal Reserve, they purchase securities from banks, just like with the open market operations. But these banks are in trouble. They might be failing altogether. They can't get loans from other banks. So the Federal Reserve is the lender of last resort. It's one of its functions. Now they're only going to buy these securities to hold them as collateral. So the bank agrees to buy these securities back from the Federal Reserve later, plus any interest that has accumulated over the period of time that has passed. So it's just a basic collateral-based loans with the securities as the collateral. The only difference in open market operations is that the bank has to buy the securities back, and there's interest attached to it. Finally, our last one is the foreign bank swap lines. Now we know that any of these financial crises in modern times are not exclusive to the United States, whether it's the Great Depression, the housing market crisis, the OPEC oil crisis, or this coronavirus thing that's going on. All of these are global crises. Whatever happens to one country affects another. So the Federal Reserve needs something to do to try to help ease the global effects of some of the things that they are trying to do. And their tool to do that is the foreign bank swap lines. And this has to do with the fact that Germany doesn't have the same kind of money as the United States. China doesn't have the same kind of money as Japan does. We all have different kinds of money. So the Federal Reserve agrees to exchange currencies with foreign nations to provide them with some liquidity so that there's money in their economy in US dollars to try to ease the global crisis, stop the momentum of the crisis as it is going on. As always, thanks for watching, guys. I know I've hit you pretty hard with a lot of vocabulary, but I think you all understand the language now, so we can get into looking at some of these historic instances that have happened, some of the early panics, runs on the bank, and how that was dealt with, the Great Depression, the OPEC crisis, the housing market crisis, and then figure out what's going on with today, and let's make some predictions as to what's going to happen. So it should get really interesting from here. I look forward to hearing what you all have to say about it. Have a great day, be good people, do good things.